If I hold on to an asset that's not going to perform as well as I thought it would over the next several years, it's not only going to be painful, but it's going to prevent me from buying other things to kind of balance that risk and move my financial goals ahead. And so I think all of us, whether we're commercial or real estate, have to ask those questions. What is our risk tolerance? What is our time horizon?
In the last 48 hours, I have heard Ken McElroy say he is buying, and I've heard Ben Mallah is selling. These two legends of the commercial real estate investing space are doing the exact opposite thing. How can that be? More importantly, what does it mean for us, the small time investors? Well, I thought I'd have a conversation with my good friend Anna Kelly and figure out what the heck is Ken doing? What has Ben doing? Break it down. Does it make sense? And of course, ask what the heck should we all do? Anna, how you doing?
I'm doing great. Good to be here with you. And I really like this topic. I'm going to be totally transparent, even though you called them both legends. I know Kenny McElroy personally. He's a good guy. He's been doing this a long time. So anyone in commercial, multifamily specifically, for sure knows Kenny. And I know he's got a very optimistic prediction for what's going to happen with commercial, well, especially multifamily, because that's his niche. That's where he's really specialized. And he has a significant number of decades of experience. So when you see pain, and we've had a lot of pain in commercial and multifamily, there's always big opportunity amidst the risk. And because he has that experience, he's probably got a pretty high risk tolerance, but he's also been through a lot of things and knows how to rush in and do it safely and wisely. Now, when it comes to Ben, I've heard his name, but I don't know him. I've never heard of him. I've never heard him speak other than you've mentioned him. So tell me a little bit about his thesis and why he's selling and what he's saying about what he sees. Is his niche specifically multifamily? How
Yeah.
many units does he have? What's his experience? And what does he think is coming?
Yeah. So Ben Mallah, you're just a genius. Even though you don't know him, you've already identified really the key delta. They're both in commercial. They're
Mhm.
both gigantic. It would not shock me if both of them, are certainly worth $500 million, 300.
Okay.
They're up there. They're huge players.
Mhm.
Like Kenny, Ben's been doing it for 30 years, maybe
Okay.
40 years. However, his focus is not multifamily. Now he has
Mm.
some, but if you break down Ben Mallah's portfolio, it is a lot more retail strip centers
Mm.
and hotels.
And it's a different animal. It really is. Even though we categorize it as commercial because it's more than a 1 to 4 unit residential housing type of facility or real estate, commercial is a broad category that contains very many different animals from, like you said, retail, strip centers, industrial, warehouses, self-storage, apartment buildings, and all of those things are having and have had historically very different outcomes and different levels of distress depending on what's happening in the world. And so that makes sense why I really don't know him because I've never played in that industrial retail strip center place. Anything that I've done like that has been very small mixed use. So I just haven't followed him. But I just based on what you said, commercial retail and commercial office have taken the biggest beating, and there may not be as much rosy horizon of that bounce of values bouncing back and lease up spaces bouncing back in the horizon as you might have in multifamily where people just have a foundational need, which is housing.
Yeah. Shelter is one of those things on Maslow's hierarchy, right? Water, food, shelter. It's number three for a reason. So the other thing that when you look about Ben Mallah and Ken McElroy is they both have done an amazing job of documenting what they've been doing for the last 5 years. It allows us to, sit back and look at what the big boys are doing. And again,
Yeah.
I've watched probably 100 videos over the last 5 years of both of them. I'm going to give my summary of those videos.
Great.
Ben has been rather active in acquisitions starting from 2020. Again, very much retail, hotels. He has done some multifamily, but not a large percentage. As he has documented, he did not lock bet. He has talked
Lock
about
their
it.
rates.
Lock the rate. Yeah, lock the
Okay.
payments. So he has talked about interest rates going up on him 200, 300% because he did not
Absolutely.
lock the rates.
And can I
So
just
he,
say one thing real quick, just to his credit, again, having no idea who the guy is, but a lot of investors will go, these idiot commercial real estate investors, how could they not have seen that rates could go up with inflation, right? A lot of the things were bought before all the helicopter money and rates were going up. But the other thing about commercial loans, where multifamily has this really safety net that a lot of others don't, is that unless it's a smaller loan where you're going with a small local bank that might lock in your rate for 7 or 10 years, most loans done on commercial, the longest you've been able to historically lock those interest rates is 5 years. And if you're in the value add game where you're turning them and selling them in 2 to 3, the prepayment penalties can be millions and millions of dollars if you lock in for 5. So historically, they've said, hey, I can only lock in 5, but I might have to go a short-term loan even, especially if they're developing or redeveloping that building. They didn't have the option like I did with Fannie and Freddie multifamily, like Kenny McElroy did with Fannie and Freddie loans, or even HUD financing, to lock in those rates for at least 10 years with some options on prepayment. So it's not that, a guy like Ben, obviously, you say he's been in the business decades, he's a smart guy. So I'm sure he didn't just go, oh, there's no risk that rates would go up, but he probably didn't have many options at the time he was doing these acquisitions for longer term financing. And so even really great operators, I know we like to poo-poo, and trust me, there's mistakes made. And I've made mistakes as well, right, over our investing career, not timing the crystal ball quite accurately. But a lot of the distress, it's not because the operator was necessarily an idiot or took too much risk. It's kind of the name of the game in commercial, that you just don't get those sexy long-term interest rates. So I just wanted to throw that out there real quick.
oh, I think that's, and Ben would thank you for that. He's very boisterous, and sometimes
Yeah.
the four-letter words come out, but that is absolutely what happened. So again, what Ben Mallah was more back to, so Ben Mallah was active during this 4-year period. That structure bit him in the ass. And
Yeah.
McElroy has been very clear, my opinion, that he was trying to buy deals the last 2 or 3 years, and his discipline didn't allow him to participate. Meaning,
I'm right there. Yeah,
yeah,
right
yeah.
there.
So I think that is interesting. So not only really different subsections of commercial, but really different acquisitions during this time. So that's kind of
Right.
the difference.
Yeah.
Um, So what Ben is doing now is, it appears, again, he had a conversation with Graham and Jack on the Iced Coffee Hour on his channel as well, Ben Mallah. He's cleaning up his portfolio and he's liquidating. It appears he's trying to get flat, trying to get to nothing, because he sees opportunities on the very near horizon. So it's going to be very interesting timing, right? He
Yeah.
probably will sell some because some people have 1031 money and they want the triple net buildings and all of that. But I think if Ben were given true term, he would admit that he should have tried to liquidate last year instead of this year. It's like, hey, this is a really weird time to sell, right? Winter before an election, rates are coming down. But
Yeah.
really where Ben Mallah is saying, kind of closing it out with Ben, is he sees a gigantic crash coming in his segment, hotels, retail centers, talking
Mhm.
50, 60% in that assets. And what he wants to do is get down to a no debt so that he could go on a buying binge in the next, I don't know, call it 1 to 5 years. That's his
Right.
goal. That's his goal.
Right. Right. And I think there's a lot of little nuggets or lessons that can be, learned even for those that are playing in the residential space, right? And that's that every investor has truly a different perspective of risk and the future, right? Especially depending on the data that we talk about so often, and whether you think it's going to get rosier or doomier macro, right? At the global level or at the national level. But then also you have to look at your particular sector, and you have to know it really, really well to know, can your sector benefit if there's distress in the macro economy in some way, and can you take advantage of that? or is your sector, primed to go further lower, right? So you mentioned like he's in hotel, he's in retail. And if you think that there's going to be a more negative economy, less growth than there is today, forget recession or not, right? But a contracting or flat economy that's going to struggle to create the level of expansion and growth that we've had in the last decade. If you don't want to hold it for a decade, you might be thinking about, and probably should have been thinking about sooner, what can I liquidate if it's gonna be more of a struggle rather than an ease to operate these buildings over the next decade or so. So if you're in a sector and you think that, like I suspect Ben does, and what you just said, that there's going to be some softening in the economy, if you think there's going to be more distress, and we're already seeing it in hotels, in travel, all of that, in fairness to him, really boomed post COVID. It was like all this revenge spending, but it's
Yep.
starting to really slow and struggle. And so you've seen some people, for example, convert hotels into short-term rentals or apartments because there were so many hotels on the market because they started to struggle with all this competing Airbnb as well. And so when you're an investor, you really have to first say, where are my risks, and what are the risks that my property values fall significantly or that my income falls significantly? And if you think we're close enough to the peak, just barely contracting, you still could have quite some time. As we've seen, these shifts in the economy have lags that can take a couple of years to even, hit that bottom. So if he's seeing a bottom, he's got to be thinking, I'm in an asset class that if I don't sell now, even though values are down, I could have a lot further to fall. And that could prevent him, number one, it could make him go bankrupt.
Yep.
Any of us, like if you have too much debt and you have to refinance it when values are falling or income is falling, it can wipe you out. But number two, it prevents that opportunity cost, which is a second part of what you said, is if he's so highly indebted or he did a lot of these projects and he's got a lot of money into them and hasn't pulled the equity out, that debt could also hurt him from being able to acquire new stuff, even if he raised all the money from someone else. So it's
Hmm.
this opportunity cost of, if I hold on to an asset that's not going to perform as well as I thought it would over the next several years, it's not only going to be painful, but it's going to prevent me from buying other things to kind of balance that risk and move my financial goals ahead. And so I think all of us, whether we're commercial or real estate, have to ask those questions. What is our risk tolerance? What is our time horizon? If your time horizon's short, and the asset's not going to perform very well, that's a good time to sell when you're still somewhat at a peak, contracting before. Otherwise, you could have to wait, a decade before
Yeah.
those values come back and you can sell. And so I sold like Ben, and I think you and I talked about this. A lot of investors say the worst thing I ever did is I sold, right? But when you have these cusps of an economic shift and things changing, you have to look at what your risks are. So I sold a lot of property that I really didn't want to let go, but I let go so that I could get very liquid for two reasons. One, I knew that as interest rates were going up, that would make cap rates rise, and automatically my values would fall, no matter how stable they were. It's just how it works, right?
Yep.
So I knew values will be down when my 5-year loan resets somewhere in this period, and I will have to refi. And because I took 75 to 80% LTVs very safely at the time, right, loans, I knew that I might not be able to refinance those without cashing in. And that's
Yep.
exactly what we're seeing. So I thank God for the foresight to say, I need to be liquid enough. And I calculated how much I thought values could fall, how much I might have to pay in to cash and refi. And I liquidated enough that I would be able to do that without risk of default. And then I thought, well, best case is, okay, the rates go back down. I don't have to pay that in, but now I've got cash. Now I've got liquidity to weather either occupancy coming down, a recession, or to be able to go buy a bunch of stuff when there is. And I was going to look a lot better to those banks, Michael, because I had a lot of cash reserves. I could tell them I have reserves because I want to protect you as the lender in case my values fell. And I'm super conservative. Look what I did. Now, if I want to ask you for some exceptions to buy, they look at me as someone who has the foresight to protect them as well as protect myself. So you just have to think offense, defense, And then sometimes it takes time, like what you said with Ken McElroy. And I know this is long-winded. I apologize, but with Ken McElroy, and I've been in the same boat where I look for deals all the time, but I haven't done a brand new project on large multifamily. Our last one we closed December of 2022. So it's been almost 2 years. Now we're value adding, we're in the process of several, and we have a development deal that we actually put in a contract in 2022 that we're working through, but I haven't seen deals good enough to give me a return good enough for the risks that I couldn't control. So Kenny McElroy I are on the same page. We both sold stuff, but now we have to be very, very patient during this transition. Now there's a shift because we know the Fed's starting to cut rates. And as they do, that will slowly result in cap rates falling again, along with the Treasury. And that will slowly make values go back up. And so he's opportunistic, where he's been in a strategy patience mode to de-risk enough that he can't control. And until then, doing what he can to position his current assets to prepare for what's to come. So I think they're doing the same thing. It's just that they're in different sectors, so the timing's been slightly different, and there's significantly more distress coming in the discretionary space. A barber shop, if you could cut your own hair at home, a massage place, if people can't afford a massage because they think there's a recession. That's very different than now housing so unaffordable that tenants have to keep renting. And there's been a slowdown in construction, which could mean a shortage. And that's huge opportunity for Kenny and someone like myself who's investing in apartments, or any of your listeners who's investing in rental housing where there's been a shortage of building because of the stress that we've been under.
Yeah. So let's switch to Ken McElroy, because he said something yesterday, or at least that's when I saw the video, may have been posted the day before. And again, I think highlights exactly what you're saying, but also should give the small and mom and pop investors like me, I don't know, pause. So Ken McElroy yesterday said that he's already closed, I believe, one transaction, and he has a second one in contract. Again, going back to the hundreds of videos I've seen from Ken McElroy, I think what went unsaid in that video, or at least that comment, was he is shopping in Class A. And the other thing he said that I want to get your thoughts on is he thinks we're in the third inning of this 9-inning ball game.
Mhm.
And again, I think, well, first off, I think Kenny believes that. I don't think he's lying. But I think if you added on to that sentence, I think you have to acknowledge that Ken McElroy is playing at the tippity top, Class A plus,
Very
new
much.
construction, incomplete, projects that are not yet finished. And he's throwing his army of experience, liquidity, and people
Yes.
at it. And that's very
Yes.
different from Class B and Class C. Is that fair?
It is. And I think to your point, there's quite a few things where we have to be careful not to say, if a big player's doing this must be the only way that we can do it, or that must
Right.
be the best way. And you're dealing with different money, and sometimes with different financial goals, right? So for example, Class A, over the last couple years, there was a shortage of apartment buildings in Class A areas. And just to simplify it, Class A are usually those pockets of town or a downtown or a big city that are booming. It's where all the jobs are coming, so all the people are moving. It's newer restaurants, it's newer hospitals, it's newer neighborhoods, okay? And so it's higher end housing. And so you have above average income earners that are moving into the area that may not be able to or want to buy yet, especially younger millennials and Gen X and Gen Z. Wait, I'm Gen X and I'm almost 50, and I still feel like I'm in that younger group, but I guess I'm ticking up there, right? But you have all these younger workers moving in this population. So you have all this development, and a lot of what looked like it was still going to be underdeveloped suddenly when COVID happened. And then people start going, wait a second, it's more expensive to live here than I thought, or I'm losing my job. They stop moving in as quickly, and you have this oversupply. So Class A multifamily in a lot of markets that Kenny and I play in did become over constructed at the point where, when they all came open online, they're all competing for the same new tenants. And so while you may say secularly, long term, it's going to be undersupplied because people are going to keep coming, right, to an area like Dallas, where I'm developing in the path of progress areas as that's pushing out in those Class A areas. Currently, if I try to develop a new project, and it's going to come online this year, if I have 3 other brand new Class A apartment buildings coming online, guess what they're doing to fill them, Michael? Because they have short-term loans and they have to get them filled to get out of those loans or they go bankrupt. And a lot of Class A developers, guess what? They are turning in the keys. They couldn't fill them quickly enough. Their loans expired and they couldn't extend them. So that's why there's been distress, which is opportunity for someone like Kenny that has the cash to go, this is distressed. It's selling below replacement cost. Let me go get it. But he
Mhm.
has to have the financial stability, and he does, to be able to say, it may take a year to fill these all up and stabilize
Right.
them because I'm competing with 3 complexes that are giving 2 months free and cutting their rents and giving free cable. I mean, I'm seeing this all the
Yeah.
time, and it's
Yeah.
affected me as a syndicator of a Class B property that we brought to, Class A quality, where I've now got to compete and offer them at least a month rent to compete with the new complexes. So he's got to say, I see the risk. I know it's overdeveloped, but that's where the distress is. I'm going to be able to hold that thing even at 50% occupied for 2 years. And guess what he's going to be able to do? Even if you're in a recession or a recovery or you're in a stagnating economy, who comes and buys Class A buildings? It's usually institutional investors like a
Right.
REIT. So they will still pay top dollar for
Yep.
that asset in a couple years, especially if a treasury's paying, let's just say 2 or 3. They're
Right.
going to be willing to buy that asset at a 4 or 5 cap,
Yep.
and he's going to be able to sell for a profit even if you're not in an expansion. So
Yep.
that going into the fire when there's pain, when there's motivated sellers, whether it's commercial like Ben, whether it's apartment commercial like Ken, or whether it's small properties, if you can run into the distress, there's huge opportunity, but it doesn't take away the risks. So you've got to have the bandwidth to say, the opportunity's so good that I'm going to hold this thing a little longer. And I know, Ken, we spoke on a panel together not too long ago, and we talked about the risks, that are coming. But if you can buy it right, you really make your money on the buy. If you can buy it right and you put the right debt on it where you can afford to hold it longer term than what your business plan really is, then you're going to have a great deal. You're just not necessarily going to buy it for that short-term flip. You're still going to target it, and you're going to target selling to institutional buyers who aren't scared in a recession to pay
Right.
top dollar for that property. And, the difference in A and B is oftentimes those REITs, those big institutional, private family offices, whatever they are, they will pay that for a Class A, but they're not going to touch Class B. So with Class
Exactly.
B and C, I may try to go in with the same strategy, but I'm going to have fewer buyers that can actually buy it from me and pay top dollar because number one, they're too scared. Number two, if you're in a recession, credit tightens even more and it slows transactions significantly and makes your timeline much longer. And it's hard for a small syndicator to profit on a deal when credit is tight, and credit in commercial and multifamily is tight. So it doesn't work as well to try to pull off what Kenny's doing and say, I'm going to do the same thing, but I'm going to buy Class C and do it. Doesn't
Hmm.
work as well. It's going to take longer. His success is because it's Class A, it's a needed and wanted asset, and institutional buyers will pay top dollar when the time is right. So that's my opinion. I haven't talked to him about this
No.
exact strategy today, but it's a very common strategy, and why someone like him can do it will probably create significant wealth, but that doesn't mean it's going to work in a secondary, tertiary market or a Class B or Class C property.
No, I think Ken again has done a wonderful job of the last 5 years, 4 years documenting what he's doing. He's doing it again. The other thing he said in the same video is he has seen cap rates go from 4 to 5.5, and that's where he's starting to buy. That's a
Right.
roughly 32% discount just by looking at the cap rates. And what I want people to realize, again, that is a Class A asset with an exit to a REIT or other
Yes.
entity. If you
Yes.
step back and look at Class B and Class C who don't have those same exits, we're nowhere close to that, right?
Right.
And again, if people don't remember, right, and this is why I was a seller in 2019, my Class B and Class C got down to within a 0.5% of Class A in my market. That's
Yes.
not normal. That's
Yes.
not
That's
normal.
That's exactly what I was going to say with the cap rates. A lot of people kind of overcomplicate cap rates, but cap rate is just simply, if you think of it this way, this is very oversimplified, to the opposite extreme of overcomplicated. But It's just the cash on cash return I would make on the income stream of that property if I paid all cash for the asset. It's as simple as that, right?
Exactly.
So
Yep.
if you think as an investor, right? And I'm just kind of putting on my old hat as a private banker, what I would tell people, and I'm not licensed, don't take this as financial advice, but this is my opinion, right? Based on lots of history, is anytime you're going to make an investment, whether it's stocks, whether it's multifamily, whether it's gold and silver, commodities, you name it, anything you can invest in, there's something called a risk reward ladder. And you start with considered the risk-free rate of return, right? And it's supposed to be a 10-year US Treasury. So you start with, what does a 10-year Treasury pay me? And right now they're about 3.6, 3.7%. Okay. So if a Treasury was at 2, and I'm going to go back to pre-rate hikes, a Treasury was about 2. Okay. The Class A, the safest thing after, US Treasuries is supposed to be like a AAA municipal bond issued by like a state or a city, and then corporate AAA bonds, and then triple B and Class A multifamily. So you're walking up the risk ladder. Class A multifamily is considered historically an extremely low risk investment, right? But the spread historically from Class A to the Treasury has been 230 basis points. So if the Treasury was 2, a REIT would pay cash to equal a 4.3% return on their money. Okay. Class B should be probably another percent, and Class C another percent, right? So it's riskier when the buildings are older and they're going to have more mechanical failure and the tenants aren't as good quality. So you have to get a better return, which means you pay less for Class B properties than you do A, and you pay less for Class C properties than you do B in order to get that higher return for the risk that you're taking. Okay. So what happened over the last couple of years is syndications went crazy, especially on the smaller properties, and people chased yield. They couldn't make the money work on Class A. They didn't need very much renovations because syndicators aren't buying them for that cash on cash, that flat 4 or 5 or 6. They're buying them to create more value by renovating them and selling at a high price on the exit. So their cash on cash might only be 5, 6, 7%, but they're hoping to make 20% annualized when they sell it because they renovate it, right? So what happened is they paid crazy amounts of money for Class B and C, and paid almost as much for even C class properties, Michael, as
I know.
historically everyone was paying for A, because they hoped to create that big upside when they renovated. They weren't looking at the cash on cash, and their fundamentals of what is this property worth today went out the window, and they way overpaid today on the buy for that opportunity to create big upside on the value add. And that's what's gotten so many people in trouble, where now, if they try to sell it, the value is at a cap rate that has a much bigger spread between A and C, and when Treasury rates are up. And that's why so many small syndicators have just been hammered, because they overpaid. So it's critical that you understand, what is a property really worth today? And if you just start with the mindset of 230 bips above the 10-year Treasury for Class A brand new, even a small house, you can do the same thing on a brand new house that you're going to put a tenant in. And then for B, go up 1%, for C, go up 1% from there, and you'll get pretty close nationwide to about what those things should sell for to an investor and what you should pay for them. So cap rates are really important, but not enough people use them, especially in residential. They just say, hey, Anna, I want a coaching call. Tell me what a good return is. And I'm like, well, what's a good return for today? What's a good return long term? Are you looking at only the cash on cash for return? Are you banking on appreciation? What's your risk tolerance? What's your timeline? All those things are going to dictate what a return looks like to you. But the bottom line is, no matter what you think it's worth, it's only really worth what the market's willing to pay for it. And that's going to be very cap rate driven and fundamental driven.
Yeah, the key to all of this, how we kind of started the video, is what's a mom and pop investor supposed to do? And the last thing I'll say about Ken and where he's playing is, we have had price discovery. And price discovery is occurring somewhere between 5.5 and 6 caps. What we aren't seeing is price discovery, aka transactions, in Class B and Class C. So Kenny thinks we're in the 3rd inning. And again, I will add, he didn't say, but I will add, of Class A. I don't even think we're at the game yet for Class B and Class C. No transactions, no price discovery. If Class A went from 4 to 6 for easy math. It's not unheard of to think Class B will go to 7, 7.5. Class C might go to 8 or 9. And all that means is foreclosures, because you can't see a 50, 60, 70% drop. And there's not enough cash in refis to get those done. These are just foreclosures waiting to happen.
Yeah, I think we could almost do just a whole video on this. So I'll try to keep this really, really short to respond to that. But I think, generally speaking, I agree with Kenny that we're nowhere near even the middle of the game, in terms of price discovery and where cap rates will land. A lot of it really, really depends on where does the 10-year treasury go? I mean, that's the bottom line. And so all of us that have been doing this long enough are smart enough to know that we don't really know. It may go somewhere if we have a deep recession, somewhere lower if it's a deeper, deeper recession. But even with a low treasury and a low cap rate historically, you're going to see distress as well. And that distress is going to knock your income down. And especially if there's rent controls or there's, taxes and insurance keep going up, you could still have values come down, even though historically you think, oh, the cap rate should be lower because the treasury is lower. There's other risks that can make that cap rate higher. And I think as you look at Class C, there's definitely more risk, especially if it's not in a primary major city. Because if it's in a small town that has 2 or 3 big employers and you start to have layoffs, people move out, then your vacancy goes up. And so that's really the risks of not having the price discovery in B and C markets more so than B or C properties. Because generally, if you have my space that I love is Class B properties in a Class A area, right? And then I've made them almost as nice as brand new, but just keep the rents a little lower so that I stay full compared to, the Class A stuff. And so if your market that you're investing in is going to do well in a recession and you've got a lot of job resilience and population and good schools, low crime, et cetera, your property values are going to be better than that same Class B or C property that's in, I like to always pick on Oklahoma City, Oklahoma, because a lot of investors went there chasing yield and they've historically had a 14% vacancy rate. They're oversupplied and there's not enough people and jobs to support the area. So it's very local, but that's one thing. The other thing that I think people miss that could make it as bad as what you're saying, Michael, is that credit for even multifamily has tightened significantly. Fannie and Freddie, if you're good and very expensive, that loan I could get for 80% today, I'm being offered 65% LTV. So you've got to raise a lot more money, which is harder to do from investors who are spooked and scared of the market, right? But it reduces your returns significantly. So a lot of us have made money by leverage, and leverage is great when it's positive leverage, but when it's negative leverage and the more you borrow, the less return you make, you got to put down a lot more cash to make those deals work. And so transactions will continue to be slower in Class B and especially Class C stuff, because even the buyers that want to buy them are going to have a lot harder time making returns and the bank to give them the money. When credit tightens, values fall. That's just the reality. And so you've got to have the bandwidth and the wherewithal to have more cash, put more down, and then the transactions will happen. But Dallas, for example, is the most traded market for multifamily in the country. Do you know how much transactions are down in Dallas?
80%. 80.
90.
Oh,
90% from 2 years ago.
no
90%
price discovery,
transactions.
folks. No price discovery.
That's Class A, B, and C. So even though A is starting to trade, it's trading because it's the big institutional investors who have the long game. The B and C aren't trading because institutional investors and syndicators are not going after them. So it's going to take some time.
Exactly.
And hey, if this game was easy, everybody would be doing it, right? It was easy for a few years because we were in an expansion. But the reality is, and everybody just needs to understand it, it's going to be harder to make those kinds of returns in the next several years than it was before. But that's also why we keep doing it. The returns are there. The opportunity in some ways is going to be better for us, especially if you start to see these foreclosures. And I think there will be a lot more multifamily distress a year from now and 2 years from now than what we've seen so far, because so many lenders have modified their loans and said, kick the can, extend and pretend. It's survived to 25. That's the mantra. And if things are not better and credit doesn't loosen, next year or we're in a recession, then they may turn over the keys, which is big opportunity for us. So be ready, be opportunistic. Like Ken is opportunistic. Well, so is Ben, I'm sure.
I'm
He's
sure.
just
Yes.
selling because he wants to de-risk and have a lot of money to go in when the distress is there, and it's coming and it's not over.
Yeah. At the end of the day, kind of going back to what folks that watch my channel should do, knowing what Ben is doing and Ken is, realize that these guys are playing in different asset classes than all of us, or at least most of us. And I think what Ken is doing is really highlighting that it's starting at the top and it will just take time to feed down. So again, I think that the fact that Ken thinks it's the third inning for Class A, I will once again say, I don't even think the game has started for Class B and C.
Oh,
The
it
game
started.
will.
Michael, baseball's slow in the first few innings. It always heats up and gets excited at the end. Ask me how I know.
There you go. Astro fan right here. Astro fan.
That's right.
Anna, you are amazing. Thank you for all of this. Where can people find you?
Great. You can find me here on your channel, social media, Anna Kelly, REI Mom, and for real estate coaching, consulting, and opportunities for accredited investors when they're good. You can find me at AnnaKellyInvesting.com.
Thank you so much.